Okay, so we're going to have a quick discussion about NUAs and how to make that decision when the time comes. First of all, we'll need to understand a couple of terms. The first would be cost basis. Okay, and what cost basis means is when you purchase a stock, so let's say you purchase a stock and you buy it for $10. That's how much you bought it for, okay? And in the future, that $10 stock grows to be valued at $40. Okay, so now you have a $40 stock. That's viewed as your cost basis. And what that means is that this $10 right here is how much it costs you, so that's your cost basis. And this is its total value. Okay? So remember that your cost basis is how much you actually paid for everything. And then the value was, of course, something entirely different. So let's go ahead and erase all that. So that's the cost basis. The cost basis is how much you pay for something, and the value is how much it's worth. So in the 401k, let's say you purchased company stock. And let's say throughout the years, you paid $10,000. Alright. So you bought company stock and it was $10,000. So this, again, is your cost basis. And over the years, you were waiting for retirement, you turned 59 and a half, and this has grown and is now valued at $100,000. Okay, so this is your cost basis, and then this is the current value. Okay, now in here, there's something called your NUA, and that stands for Net Unrealized Appreciation. Okay, so the NUA is your Net Unrealized Appreciation. And that is the difference in the current value and your cost basis. So doing some simple little math here, we would just do 100,000 minus 10,000. And we would get 90,000. Now that is your NUA. Okay? And so when you come up on retirement, you have the option of either rolling this $100,000 into an IRA, and then it would be treated like anything else. And then this would be, you can invest in something else, and or you can choose to keep it as company stock inside of an IRA. But the important thing is if you put it in the IRA, it's going to be taxable a certain way. And some would say that you should take your NUA, which means take this value. Now, if you take this as an IRA, this NUA, this is all just done away with. Instead of this being 90,000 in NUA, all the cost basis will disappear. That won't matter. All that will matter is the current value, and that'll be a part of your IRA, and that'll be taxable as ordinary income when you withdraw it. Now, if you want to take your NUA as part of this process of retirement and putting your money into different accounts, there's a couple things you would consider. So again, we have your 10,000K as your cost basis and your 90,000 as your NUA. Now, if you were to change this over into a brokerage account, this amount right here would become taxable as ordinary income. Okay, this is really important. We'll come back to this. This will be taxable as ordinary income, and you have to pay this up front. Okay, so at the end of the year, you're going to get a bill for this, and you're going to have to pay that money out of pocket. Now this, however, this NUA is the net unrealized appreciation will just go into the brokerage account as a part of this. And it'll stay valued that way, and let's say it grows from there. This 90,000 over the years, as you get closer and closer to retire, will grow and grow and grow. And this will be taxable as capital gains. Now there's long-term and short-term capital gains. Long-term means you held it more than 12 months. Short-term is less than 12 months. Now the advantage of capital gains taxes is they're taxable at different brackets. Now as we go down here to the brackets, as you can see, these are the short-term capital gains and these are the long-term capital gains. The short-term capital gains are also the same as the ordinary income tax rates. So as you can see, there was, what do we have, 10K, that would be taxable as ordinary income, that would be taxed along these lines. These lines right here. Your 90,000, this right here would be taxable along these lines. Okay, so as you can see, these are substantially lower, and with 100,000, let's say you were in this bracket, you know, that $90,000, that'll be a difference of about $9,000 in taxes. Okay, it's a 10% difference. So you want to get as much as you can over into these tax brackets that are lower than the ordinary income. So simply, NUA is just the process of turning that money in your 401k, those company stocks, over from a tax-deferred account, okay, into a brokerage account. And in that brokerage account, the government would make you pay taxes on it. It wouldn't be like when it's in the 401k and over the years you don't have to pay taxes on it. So at that point, it would change into, here's your 10k. Okay, and we're just gonna color your cost basis in green. Okay, and then over here, this is your 90k. All right. So this is all the growth. You put in 10k, it grew to 100k. So this is your $90,000 in growth. Remember, once again, this would be taxable as ordinary income. Once you pay those taxes on that, though, you're never going to have to pay taxes on this again. So you do have to pay ordinary income, just like before. If you had rolled it over into an IRA, you would have to pay ordinary income. So it would still be taxable at those higher rates. So you're not losing any taxes here. I mean, you have to pay them in the current year, but you're still going to be taxable ordinary income. But in the future, this 90,000 and any growth from here, because remember, it can still grow or shrink. It could go either way, but anything beyond that 10,000 is taxable as capital gains. And again, those are advantageous because they're a lower bracket. Okay. So basically, when you come on retirement, you're just going to call your 401k company and you're going to get a couple figures, and you'll just do an analysis with yourself if it's worth it or not, paying those ordinary income taxes up front in order to get your NUA. Okay, and for some people the NUA is really large, and that's definitely worth it. So we're just going to go over this one more time to make it as clear as possible. Any money that you put in, the money you buy, okay, that's called your cost basis. Okay, that is money contributed in order to purchase. Okay, this is your contributions. All right, contributions, whoops, become your cost basis. Oh man. All right. Over here, however, growth. Okay, growth turns into your net unrealized appreciation. Now it's going to be this until you realize it, and you realize it when you actually sell that stock and take that profit. Okay, that's when it's in the brokerage account. So your growth becomes that NUA. If you take the NUA, this is going to be taxable as ordinary income, and the growth is going to be taxable at capital gains. And remember, there's a big difference between the two. Okay, ordinary income is taxable over here, capital gains is taxable over here. So you just have that simple little view. If we simplify this, I like to look at it in this way. Okay, your contributions. Okay, we're going to scroll down. I need a little bit more room. Can we go here? Your contributions. Okay, this was the 10k in this scenario. That's your cost basis. And then any growth beyond there, this is your NUA. So in this case, it was 90k. This is your NUA. Okay, and again, the focus is taxable as ordinary income. All right, taxable over here. This is taxable as capital gains, and this can be advantageous. Alright, and that is the main decision and what you have to do behind taking your NUA. Now the arguments would be against it. If you were to roll this into an IRA, you would not have to pay any taxes up front, so you'd pay 0 taxes up front, and then later as you withdrew the money, the growth, everything there, you would have to pay it at ordinary income. Okay, so this would take 100% of your money. Okay. and tax it on this side of the chart with the higher tax brackets. The NUA would have this part of your money. And this isn't always going to be 1090, but it'll take the growth on your investments and tax them on this side, much lower. And you would have to be taxed on this as ordinary income.